and welcome to our discussion on deferred roll forward columns, part of our series around one source tax provision functionality. So the deferreds are located, of course, in our reporting area, deferred balances, and today we're really going to focus on two: the expanded balance sheet view and the expanded income statement view. So if we talk about the deferred roll forward, that income statement view that I mentioned a couple seconds ago is a canned report and cannot be changed. The benefit of that particular report is that it allows us to be able to see the role of the activity from the beginning through the ending balance, but more importantly, it allows us to see what pieces of it are impacting our P&L. So we'll get into that a little later. What I want to concentrate on to begin with is the balance sheet view of that deferred roll forward. And if set up correctly, this can kind of help us to get a lot of useful information. So the sample that I have up here is using classes. And with classes, we can kind of get a little bit more specificity around where we put things on the deferred roll forward. Part of the issue with tags is because we had very few of them. Over the years, when I've taken a look at clients' roll forwards, they've kind of gotten bastardized and they're used, when we want to reflect just balance sheet activity, but also when we want to reflect income statement, and it's kind of hard to be able to tie things out. So I will say the knock on the income statement view is that the deferred only column that shows up just kind of puts everything in. So you're not sure what is in that deferred only column. It's a big bucket. Whereas the balance sheet view, you can kind of customize it and put the columns that you want. So right here, what I have is a view of a pretty simple and I would say fairly standard view of the balance sheet roll forward. The items here on the left, the beginning balance and the rate change, along with the ending balance, cannot be changed. Those are static within the software. And because this is a view you can customize, one source tax provision provides a kind of a column that allows you to kind of check to make sure that things have been assigned correctly or put into the right columns and you don't have anything hanging out. So it's kind of like your review column, and that can be put wherever you want it. Most people tend to put it at the back end. The columns in the middle that are shaded in green are all customizable. So what I often see is that clients want to kind of put columns that will reflect, prior year activity per se, things that really impacted their beginning balance. But of course, when you roll over, this column is going to be reflective of what your ending balance was last year. So we'll typically set up columns and put a beginning and adjusted beginning balance column, which can be set up within the software. So everything to the left becomes things that impact your beginning balance. Everything to the right becomes things that impact your current year's activity. So right here, I've got two columns. I've got a prior year balance sheet only, and I have a prior year deferred only. These are in addition to a return to provision column, because almost everybody will want a specific return to provision column. But best practice is really to carve up your prior year activity so that you know what pieces are P&L related and what pieces are balance sheet only related, which is why we have two columns here. That we are driving the data with specific classes. To the right, we've got what I call current activity. So for this is really your current deferred flip, not to be confused with activity during the current year, right? So this is just your current deferred flip. And this is the piece that will always show up on the tax provision report itself as part of your temporary differences. Then we've got a few other columns over here that are balance sheet only. And I'm showing here that if you want, you can break out into 3 different pieces: purchase accounting, OCI, reclasses, but not everybody needs that level of detail. So you could do one column that's called balance sheet only current year if you wanted to put all things together. I will typically say when I'm working with clients to create a deferred roll forward view, what are your reporting needs? Because if you have particular activity that is prevalent in your business, you are going to potentially want a specific column for that. So if you're very acquisitive, then you're probably going to want a purchase accounting column and will not want it commingled with multiple things. And then there's a deferred only column for the current year, which would be representative of things like your valuation allowances or maybe credits that you generate, or any kinds of write-offs that you might want to have. So all of that goes together and then gets your ending balance. But the goal is that at the end of the day, we're not mixing and matching things when we assign activity to the different columns. Now, to help you with that, within the software, there is something called classes to components. So when you set your classes up, and if I go back, you will see I kind of have my classes at the headers. I am saying which classes I want to go to what columns. You can kind of hard code that or hardwire that in the software. So classes to components allows us to turn off certain activity. So if I pop into the software here and go to my temporary differences, so this will be the area where you take a look at your entry. So beginning balance will be turned off for most of your users because we do want to shut read write off on beginning balance. But your activity, deferred, and balance sheet only columns are really what we care about because those are going to drive activity to your specific columns. So with the class of components, we can say for a particular class, like for my balance sheet only classes, prior year, current year, if it's a temporary difference, first of all, I don't want that class to be used for anything else other than temporary differences. But when used with a temporary difference, because it's balance sheet only and I want it to go into a specific column, I want to make sure that users do not use it for deferred only activity, which is really set up for P&L type activity. So by putting balance sheet only, I've taken away the deferred only activity. What that does in the software is it locks the activity cell and the deferred only cell and only allows input if that class is selected in the balance sheet only column. So that is what we would want to do when we're setting up our classes to make sure that we are driving the correct data to the individual columns. Okay, so one other thing I would like to go through with you is really just how the income statement view of the report works. And I know this is sometimes confusing for a lot of folks, and it's oftentimes a report that's not used very much, but I love using this particular report because, as I mentioned earlier, I can see from the report what impacted my P&L. And it's kind of what we're trying to get to by setting up this report in a particular way. I know if I do it correctly, then I should be able to pick my deferred only prior year, my RTP manual, my deferred only current year, and I should know my rate impact if I run the balance sheet view of the report. But the income statement view of the report will tell me that right here. That's my rate impact. But I have a problem because, as I mentioned earlier, the deferred only is, there's only one column called deferred only adjustments, which from this view would encompass your deferred only prior, your RTP, and your deferred only current year would all be commingled in that one column. And you don't really have any insight into the data that's there. So really, we've got our beginning balance, and then we have all the things that kind of go into our rate impact. So the current provision or the current activity column, the rate that is used in the deferreds on the current activity column is actually the rate that has been set up as your current statutory rate, and for states, your current apportionment rate as well. However, if your deferred rates are different from your current rate, the software is going to have to true that up. So that's my column F here, or the software will say C, and that's really effective rates different from statutory. That's the differential between the current rate that's being used and the ending deferred rate. So in this sample here, I'm saying if your current rate is 19%, but your deferred rate is 17, then this is going to be the 2% differential, negative 2% differential, to get you from 17 here to 2%. From 19 here to 17% here. And that, of course, has an impact on the rate, because now the current deferred flip doesn't net to zero. But the reason it's done that way is because the assumption is that your current deferred flip should be zero, but it's sometimes not. Column E, or B, as it says here, is actually the rate change on your beginning balance. So this is this balance here that's in column C. And then, of course, you have your deferred only adjustments. So your total rate impact does not include your current activity. So if I sum all three of these up, I will get to my 693,117. However, your current activity column does go into your total deferred provision. So that's what this 167,540, oh, I'm sorry, I added up an extra column. It's your 167,546 is the total of these four columns, because of course there's going to be a current offset, which is why this does not go into your total rate impact. If you're doing reporting currency, you'll also see a currency translation adjustment, and the software will do it. There are going to be 4 columns going into a CTA, total CTA column. It will calculate the currency translation on your beginning balance, as well as any currency translation on your current activity, the rate impacting items, which is the rate change on your beginning balance, currency translation on the rate differential, and then anything you also have in your deferred only column. So that's what you see going on here. If I translate that now to my regular roll forward, if you remember with the regular roll forward, you'll only have one rate change column. So that rate change column is a combination of the actual rate change on the beginning balance, plus the CTA on the beginning balance, and the CTA on the rate, sorry, so CTA on the beginning balance and CTA on your beginning balance change as well. So that's 804, negative 941 that you will see right here. And then your current activity that you see in the roll forward is going to be a combination of the regular current activity plus any differential between current and deferred, plus the CTA on the current activity, and that gives you your 525,075. So I know it could be a little bit confusing, but the reports all do tie together, and it's just a matter of running the different reports and getting comfortable with them. So I hope you found this useful, and I look forward to seeing you in another session.